Great. So good afternoon, and thank you for joining us today. I'm Iris Wu. I'm currently an MBA candidate at the Wharton School and also an EIR in training at Menlo West. I'm also a CMU alumna, and I am super pleased to be our moderator for this panel on the topic of how to get into an accelerator. Today's topic, we'll be exploring what are startup accelerators. Is an accelerator program the right choice for your startup? And what are the risks and benefits of an accelerator program? And joining us today are our two amazing entrepreneur investors from Peer VC. We have Richard Zhang, who is the Chief of Staff and Director of Accelerator at Peer VC. He's also a healthcare AI researcher at Massachusetts General Hospital and co-founder of Fail. In the past, he was the venture associate at Pillar VC. He also holds a PhD in mathematics from MIT. And next we have Arman Hezekani, who is also a CMU alumnus. He graduated with a BS from ECE at CMU in 2019. He's part of the Peer VC accelerator program from the most recent cohort, and he is the CEO and co-founder of Parthian. Before co-founding Parthian, he was the CEO and founder of the Has Inc., an educational consulting company working with clients like Google Cloud and Google. He was also the COO and co-founder of Intaco. And welcome to Richard and Arman. And we will get started. And to start, can you each give us a little more color to your career trajectory? And I think I'll start with Arman first, because most of the audience today are aspiring entrepreneurs. Could you let us know, how did you stumble across entrepreneurship, and what are you building right
now? Thank you. Thank you everybody for having me as well. Excited to be chatting with this community. So for me, there's kind of three different parts to my career trajectory. The first is education's always been a part of it. The second is business has always been a part of it, and for-profit business specifically. And then the last is tech. And so when I was in high school, I was thinking a lot about like my parents are from Iran. We used to spend summers there, and I'd see a lot of economic differences, political differences, right? And specifically differences in opportunity for people in the United States and people in Iran and around the world. And I wanted to think about how I can spread the most impact in my career. And I thought that education was the most impactful thing that I could do. The most high leverage impact that I could make was through education. And the next thing that I thought was, okay, I can go teach like 10 people at a time, but how do I scale that impact? And that's how technology came in. And then the last thing was, how do I make that impact sustainable? And business is often the most sustainable way that you can make any form of change as compared to like using government institutions or nonprofits or whatever. I think that for-profit businesses have a really good way of making impact sustainable. So that's kind of like the thesis that I've used throughout my career. And then when I was in college, I was a TA and then a head TA for 15112, which is a big computer science course there. I was an instructor for a course, or like an adjunct professor after I left Carnegie Mellon. I started my first ed tech company my freshman year. We went through Alpha Lab, which is a local accelerator in Pittsburgh, and that was a great experience. I did education work at Google for 2 summers, and then that's when I started my second company, which was AHES Consulting, where we're doing curriculum development, things like that with big enterprise clients. And then that eventually led me to Parthian, which is our current business. Right now we're building really engaging, interactive, mobile-first financial education. And we're starting with a really tight focus on Gen Z, and specifically people who've just started their careers. And we're teaching these folks how to manage their finances, how to make their first investments, savings, budgeting, all these things. And we are a part of Pear's Accelerator, which is wrapping up in 2 weeks. So it's a very busy time. And we're also a part of Venture Bridge, which is Carnegie Mellon's accelerator. And that one ended, that one wrapped up a couple of weeks ago as well. So we're 2 accelerators this summer, so we have a lot to talk about. Richard, you want to talk about your career?
Thank you. There was a technical issue. Now I'm all set. So
Awesome.
yeah, Iris, thank you very much for hosting the panel, and KP, thanks for the invitation. It's great to be here. I'll just preface my self-intro by saying that unlike Armand, who knows what he wants from the very early on, I didn't really know what I wanted in terms of my career. I went to NYU for undergrad, where I studied physics. And at one point I was very certain that I want to be a theoretical physicist, and that's why I decided to pursue a PhD in applied math at MIT. And since this is CMU, I guess I can get a little technical. My thesis focuses on solving partial differential equations analytically. With applications to microfluidics. So I study the flow pattern of fluid with very low Reynolds number. If that ever makes any sense to you. But throughout this whole academic journey, I felt like something was missing, right? Like I think academia and the pursuit of knowledge is very much entertaining and enjoyable, but it doesn't at the end of the day. It doesn't really make a dent, right? My solution can converge, or it doesn't converge as n goes to infinity. But does it improve? Does it make people feel better? Does it improve? Does it solve any real impactful problems that exist in the world? And oftentimes than not, the answer is no. If anything, the only product that you build as a result of academic inquiry is a paper that you published in an obscure journal that nobody ever reads after it gets published, except when they except that when they need to write papers and they need to cite all the relevant authors, and then they read the first 2 lines of your intro and then they cite you. So I thought that was not the kind of career I wanted to pursue, except that I don't really know what is out there. I think that was kind of like second year, third year of my PhD at MIT. I don't really know what is out there beyond academia. So I started organizing lots of events at MIT, focusing a lot on career and professional development for graduate students. At first, those events are for me to understand what is really out there, but the more events I organize, the more that I enjoy the process of event organizing and community organizing and bringing people together. So I thought to myself, man, wouldn't it be better if there's a career in this world where I can organize events for a living? And people are like, well, you should look into early stage VC because that's all they do for a living. And that's when I decided to do a internship with a Boston-based venture capital fund called Pillar VC, where I focused on deal sourcing diligence and community organizing, mostly for healthcare and health tech community. And there's some work that I did with Mass Gen that I'm happy to get into. But that's when I validated my hypothesis that yes, I do want to pursue a career in VC. And Pear had a position of the director of Accelerator open, which I applied and got lucky. Here I am.
Amazing. So speaking of competition, I'm sure you've seen kind of the raising bars in accelerators, increasing in volumes and qualities to the applicants. So when you talk about successful founders and investors, what characteristics come to mind?
Sorry, I missed the last part of your question, Iris. Would you mind repeating yourself?
What characteristics do you think successful founders and investors possess to be able to become successful?
Yeah, and of course, the real answer is always it depends. But there's some general buckets of answers that I can throw out there, and I'm happy to bounce off ideas with you, Iris, and Armand. I think in general, we're looking for when we evaluate a company, we're looking for founders who are resilient and who are humble and who we can see, number one, executing executing this idea and be in command of the company, and number two, whom we can really work with, right? And that says a lot about the experience of that founder, aka whether the founder has the ability to carry out this business, and also really why the founders are motivated to solve the problem that they would like to solve, right? So that's generally speaking the buckets of characteristics that we're looking for, and both for the founders and also for the team overall. Not just one founder, but everyone that's on the founding team. So yeah, and I'm happy to elaborate. I can go on and on, but I'll pause there and see if Arman or or Iris have any thoughts.
Awesome. So Arman, definitely want to hear from you from a founder perspective. Because of the current barriers to entry, how do you think this shaped your characteristics or how you approach joining an accelerator?
Yeah. So I mean, are you asking like the same question? Like basically, what are the characteristics in founders? Because
yeah, if you talk about it from a founder's point of view, that'll be great.
Yeah. So I mean, there's that classic thing that I hate quoting Elon Musk because I think it makes me a caricature, but like the thing that he said about being an entrepreneur is chewing glass and staring into the abyss, whatever. Like before you're a founder, you're like, oh, like, wow, that seems like really exciting and fun. Like, like hard problems. Like everyone wants to think that they really want to solve hard problems. But like, then you dive in and you're like, no, this actually is really hard. Like this really sucks a lot of the time. And I think that the biggest thing is having the personality to like be sitting in that pile of crap and just like pushing through that. And I think a lot of what Richard said and a lot of what you hear when you speak to every other investors and founders and things is it's not just that characteristic of like being comfortable in difficulty, but it's like I'm very comfortable in education related difficulty, but if you throw me in a company that I don't care about, I'll give up immediately, right? Because of course. And so there's that founder market fit that really, really matters as well, right? And I've like in the previous company that I was doing, that was a consulting company, and I was making way more money and it was way more comfortable and things were going really well. So it was actually not as hard as my current job is, but I wasn't passionate about it because it was like curriculum development. I was working with enterprise clients. I wasn't working with consumers. I wasn't doing what I really loved. And so any sign of difficulty, I'd throw a hissy fit. I just hated it, right? But now that I'm doing what I really, really enjoy, working with students, and I love it, even though it's incredibly difficult. And so to wrap that up in a nice little bow tie, founder market fit, I think, is incredibly important. And when you found that problem that you really care about, the resiliency to really push through those difficult times, I think, is key.
And
amazing. We'll definitely have more questions coming up for you on that. Awesome. Richard, sorry, go ahead.
Yeah, no, I just wanted to quickly double tap on that founder market fit in that, we want to make sure that the founders are motivated to work on the problems that they are addressing, but we also, and at the same time, we want to make sure that the founders are capable of working on the problems that they are addressing. And I think we're all very capable human beings at the end of the day if you try to found a company. But the point is that, if we don't really sense a DNA in the team in working in addressing a particular market or particular problem, I think there are better ways to proceed other than, forcing a company to be something that they're not.
And to your point, Richard, so switching gears a little bit, given that there are so many ways to raise capital nowadays, could you elaborate on what are the differences between, say, raising from an angel, from a pre-seed VC, or joining an accelerator?
Yeah, that's a great question, and there's so much to be said. I mean, we have hours of seminars on fundraising strategy, and the cohort is about to have one this Wednesday. But I think very quickly, I think overall, regardless of whether you're raising from angels, institutions, or accelerators, when you are raising, you're not just taking the money, but you are also bringing important partners into your network, right? You want to make sure that these are the people that you see yourself having a long-term beneficial relationship with. So the rule number one is, regardless of whether you're raising from angels or institutions, don't just take money from anyone. Take money from strategic partners, and that's I think angels can play a lot of that, a lot of that role in terms of being strategic partners. A lot of angels are former founders, are former executives, or current executives at different companies that they can introduce clients or important or bring important people into the network. When it comes to institutions, I think reputable and large, reputable institutional investors have a network of investors and operators that you can tap into. So make sure that you take advantage of that, and also make sure you pre-vet. Make sure that comes up on your research when you vet for institutions. And I think for accelerators, you want to make sure that again, the people within the accelerators, that they truly care about your success and your well-being, that the program is tailored for you, right? Not accelerator have different, I think each accelerator has its own DNA. You want to make sure that the program is the one that you want to go through.
Awesome. So Armin, has this been your experience in terms of getting accepted into peer VC, and can you speak a little bit on that?
Yeah, so I think anytime you're accepting a check, there's three things that at least I look for when I'm looking for a check. And I want to preface this with, this is in the best scenario, right? Like, I agree with Richard that you should not accept a check from just anybody, but sometimes when you need money, you will do that, and I've been there. The key is to not find yourself in that situation. So everyone says like raise before you need it, but sometimes you'll find yourself in the situation where you need it, and that's a very difficult place to be. So this is all like best case scenario when you're raising when you don't need it, right? So with that in mind, three things that I look for. First is, of course, capital. So it's not just money for the current round, but also ability to help you raise in the future. So even when you're raising your pre-seed or your seed or your Series A, like, you should always be looking toward that next round. And if your investor has connections to Series A investors, if they make Series A investments or whatever, that's really great. Second thing is relationships in the field. This is especially helpful for B2B sales. If they have a really wide network, if their portfolio is like your customer, great. If they're connected with people who are your customers, great. So that's really important in both B2B and B2C, but B2B especially, I think. And the third, which I think is the most important, is aligned vision. Sometimes when you're pitching an investor, whether it's an angel, a VC, or an accelerator, or in Pear's case, two of those three things, you're pitching, and like with any other personal engagement, they either are getting it or they're not, and you can tell a lot of the times whether or not the person that you're talking to is getting it, right? Like they're finishing your sentences. They're like, oh yeah, like, and you could do this, right? And they're excited about what you're saying. And like I was on a call, and the person, before we even hopped on the call, they were like, oh, like, you're building this, right? That's really cool. And I was like, cool, I don't even need to pitch you. Like, that is the best case scenario. And sometimes you're pitching someone and they're like falling asleep, right? And that happens most of the time. And that's because there's not aligned vision. And so if you don't have that third thing, that's not, it's the other two are not going to happen, right? So anyway, those three things I think are definitely what you should look for with any of these three things, with any, whether it's an angel fund or accelerator. And then the differences between those three, we could also talk about. Do you want me to dive into that too, Iris?
Yep, I think we're doing good on time.
Okay, cool. Do you want me to dive into like the differences between pitching the three, or the differences between like why you'd go to one or the other two, or all the above? What are we thinking?
What's more important to you?
I think like the differences between maybe like the value that they could provide, like why you would go after one or the other. Yeah. Cool.
Yeah, that'd be great.
Yeah, we could dive into that. So I think like Richard said, a lot of angel investors, people say like friends and family is often a thing. Like your first checks will be from friends and family. I hate that because I don't have rich friends and family. So I don't talk about that when I talk about angel investors. I talk about like well-connected folks who not only have a lot of capital, but also are really well-connected. Those folks are often the ones that, like, I send out investor updates, and most of the time they ignore it. But when I need them to read it, and when they're the person who can help me with that investor update, they are super responsive. They'll hop on a call, right? They'll help you out because they're often entrepreneurs and operators themselves. So they know the speed that you're running at. So I found that angels, even with a small amount of money in, are incredibly helpful, right? Because it's a person, it's not like a fund. So that's really great. In terms of VCs, we don't have VCs beyond Pear in our cap table, so I don't have much experience there. So I won't talk about it. I'll let you talk about that, Richard. But then the third, with accelerators, I think the benefit is that, like, I don't know what the hell I'm doing, right? I'm a very early stage founder, right? And I think that having partners on our cap table who know exactly what they're doing, who've done this before, and who can help me with fundraising, introductions, and have an aligned vision, like accelerators kind of knock off all three of those things. And they help us build our network among other founders, right? Which is incredibly, incredibly helpful on multiple levels. So that's kind of how I see those three things. Yeah.
Amazing, super helpful. So since we've spoken about founder market fit, let's talk about founder accelerator fit. Richard, from an accelerator standpoint, tell us about your benchmark in terms of selection from peer VC, and who exactly are you looking for?
Yeah, great question. I think, first of all, I think just to kind of quickly double tap on what Armand said about the accelerator, I think, going through the accelerator program, it puts you in a mind frame where the time is limited, that demo day is coming up, so there's no space to slack off or to even relax, right? And it puts in your mind a deadline, and depending on the kind of people you are, sometimes you get really creative as deadline approaches. So that's one of the numerous other benefits of being an accelerator. Now, in terms of what we are looking for at Pair, we're really looking for incredible founders working on problems that are embedded in a huge market. And when we talked a little bit about what incredible founders mean. People who are resilient, people who are passionate about the problem, who have the experience and the capability to carry it out, and who are humble and willing to improve themselves. All of that. And when we talk about a market, we really just can't. I think as VCs, we care if your company has the opportunity, has the potential to become a unicorn, and that is that whether you are operating in a market that is at least $10 billion or more, right? And I think there's a lot of nuances. There's a lot of, I would say, subjectivity when it comes to selecting the kind of founders, and a lot of it is based on past experience. So yeah, happy to give some individual cases. So if we see say repeat founders, that's a sign that the founder has done it before. That we have more confidence that the person will carry it out. If we see more traction, for example, with the company, even for first-time founders, we see, okay, there's potential in the market. The founder might need some guidance. Let's bring him in. Something like that.
Yeah, I was going to follow up on what are some of the tactics you've seen on founders that are successful in terms of addressing these characteristics you're looking for?
Yeah, I think for one thing, be passionate. Show passion, show motivation as to why you're interested in solving the problem, and number two, really convince us that this is a big market, right? Not overall, basically, you can't operate in a market that is, I don't know, 100 million. That won't generate enough return. Convince the VCs that you will make a lot of money, and that you make the VCs also a lot of money as well.
Awesome. So Armin, you've kind of worked with multiple accelerators, Pair, VentureBridge, Alpha Lab that you mentioned. What made you pick those accelerators out of all of the other available options?
Yeah, so there's, I think that before I was in accelerators, I kind of saw that term and thought that they were all the same. They're very, very different. Like the difference between Y Combinator and Pair, and the difference between Pair and VentureBridge and Alpha Lab, like these are all different experiences, entirely different experiences. So I think the way that we thought about it was, first of all, every one of these accelerators puts in a different amount of money on different terms, right? So the actual investment that they're making is very, very different. So Pair has really great, really great terms compared to the rest of the market. So that was good. In addition, we were looking towards those three things, right? Like, can they give us money now? Do they have follow-on capital? Is there aligned vision, and is there good connections? We thought that for both Pair and for VentureBridge, all three of these things were very, very strong. With VentureBridge, the benefit is that it's the Carnegie Mellon network, and we're just embedding ourselves way deeper in that, which we really enjoyed. And with Pair, like Pair is a VC first, and they also have an accelerator, which allowed us to, like, it's not like other accelerators where the economics are accelerator economics. These are venture capitalists, and we have a VC on our cap table. So of course we can have those follow on, like they know everyone, you know, like I don't need to talk more about that. I could if that's useful, but Pair is like a tier 1 accelerator or VC who has made, like Pejman, the founding partner, was the one who made the introduction from SoftBank to Tony, who is DoorDash's CEO. And like, he made that introduction before they made the investment, right? So like, if he's helping people out at that stage and at this stage, like, yeah, that's someone I want on my cap table, right? So that's kind of how we went about it. And of course, there's only 15 companies, so there's enough personalization. Like I was on a call with Richard earlier today. I was on a call with one of the partners yesterday, Sunday, and last week. Like every day, I'm talking to Pair. So there's that too, which is huge.
Yeah, we're very hands-on with our approach, and that goes back to saying about how founders should select the kind of accelerators you want to work within, right? And you know, YC, for example, from what I know, they take, I don't know, 300, 400 companies, and it's really hard to get investors on the call. And you know, on the other hand, they give you a lot of freedom and flexibility to work on. So, and it's a big brand name, right? Versus for Pair, might not be as strong of a brand name as YC. On the other hand, our partners spend a lot of times with every single one of the companies, and we have a very small cohort of 15 companies. So you do get that cohort camaraderie and that intimacy with some of the other companies founders too.
Yeah.
So next up, we're talking about risk and rewards, and I think both of you have tapped into some of the characteristics. So I guess, Armin, if you could talk about like what stood out to you about the Peer Accelerator program since you've been with different programs, in addition to kind of like being hands-on and then having this camaraderie, what would you consider, I guess, like when you kind of like talk to aspiring founders, for founders looking to join an accelerator, what are some of the risks that you think people should really weigh in?
Yeah, so one thing that I was very, very aware of going into these 2 accelerators this summer is the fact that like a lot of the benefits are also potential risks. So one thing that I'll say, for example, is the community that you're embedded in, right? Like I was on the phone with another one of the Pair founders for an hour today. I spoke to another person for 45 minutes yesterday. Like we're all like friends, you know, like we're truly building friendships. And same thing with the partners. Like again, Richard and I joke about how much we see each other. Like we literally see each other every day for a long time. And I hope you don't get annoyed with me, Richard. But like as an entrepreneur, you're fundamentally trying to do something that the world doesn't want you to do. And I'm not trying to get on a soapbox right now, but like you're trying to push against what society has deemed is normal, and you're trying to build a huge company that did not exist before for many reasons, right? And so to do that, you have to think in a way that people don't already think, right? And so that's why founding teams are so small, because there aren't many people who think differently in the way that you do. And so even though you're in this cohort of people who all think differently, they might think differently in a different way than you, right? And so oftentimes I think we make it like our team, we're very conscious about taking a step back, taking all the advice that we're getting, everything that we're hearing, and saying, okay, this is really great advice that we heard from this person, that person, the other person. Like, what do we believe, right? We need to take that step back to realize, like, we're building a company here. What do we believe to be true? And it's great that we have all this advice, but we don't want to be caught in the tide, right? And you hear so much, to Richard's point, accelerators, the benefit is that you're being accelerated, right? You have 3 months to talk or to work, right? And you don't want to be caught up in that, right? Sometimes things take longer than 3 months. And so those things are something that I think we do a really good job of trying to keep in mind, but could be a potential risk.
Yeah, and that's why, you know, I really like Arman as a entrepreneur, as a friend, and as a human being as well.
Yeah.
But I think speaking in terms of say the rewards, I think we've talked extensively about it. The timeline, the pressing timeline that forces you to think very strategically and think harder, and the network and the network and the opportunity to interact with operators and also investors who will work literally on your behalf. In terms of the risks, I can't agree with Armand that at the end of the day, this is your company. You're building this company. No one can build this for you, right? We can spend hours and hours, giving you advice on how to proceed. And there are risks of taking too much advice from different people. And at the end of the day, you steer the ship and you gotta make the decisions. There's a close mentor of mine who's a general partner at a small VC here in the Valley. He says that 80% of, use the 80-20 rule here when taking advice. 80% of the advice you hear is bullshit. So take the 20%. Take the 20% that's actually helpful to you. Okay. So that's number one. Number two is, I think I've seen just within this cohort, and Armand, we can talk offline about who they are. Just within the cohort, I think there are teams that I would say, are overly reliant on the advice of the partners, and they have a higher expectation for pair, for us to do the work for them. Well, that's just not going to happen, right? We can give you advice, we can tell you, we can give you a suggestion on what to do, but you have to do the heavy lifting, right? So I think that expectation should be leveled up as you enter the accelerator program.
Awesome. So question for the both of you. Accelerators often take out a cut of equity in exchange for program placements. So what are some of the best things a founder can do to maximize his or her financial upside in such a program?
I also saw a question asking like what the stake typically looks like. So I could talk about both at the same time. So the deal for, so first of all, everyone should get familiar with safe notes, because that's like what everyone does that's what everyone makes investments with nowadays. But it's basically like a convertible note, if you're familiar with that. If not, I actually recommend you read this book, Secrets of Sand Hill Road by Scott Cooper. This is how I learned about everything in investment, so please read it. But yeah, so with Pair, Richard, this is open, right? The terms for Pair. Yeah, so with Pair, they make $150,000 investment for 5% of the business. So it's valued at $3 million when you like the first investment, but then they make a second investment, which is $100,000 at a $10 million valuation. So we're giving up 6% of our business at a $10 million, and by the end of that investment, it's valued at $10 million. That is far better than a lot of the other accelerators. YC, if I'm not mistaken, is 120 for 7%, right? Yeah, 120 for 7%. So it's more equity, less money. Venture Bridge did 25 for, the terms are a little different. There's no valuation. It's a discounted percentage on the next round. Again, read this book. But typically you are giving up equity. And in terms of, Iris, you asked like, how do you maximize upside? I think with anything that you're doing, like when you're building a business, you can build a business by yourself, and you can go out and try and make as much money as possible and build the value of that business and try and make it that way. And a lot of people do that. And I was doing that. It was a lot of fun, right? Like that's one way of building a business. Another way of building the business is bringing on partners and giving them a part of your business, right? And I think as a founder in the venture ecosystem, that's the bet that you're making, is that I want to try and bring on the smartest partners that I can, give them a portion of the company such that they care about it and they have a vested interest to help this company succeed. And you're just always keeping an eye on your cap table, right? You always want to make sure that you're not giving away too much. And anytime that you give away any of it, you're doing that risk calculation in your brain. And I'm not sure there is a science to it, like whether you should give away 2% for this much potential. That I don't think that's how it works. I think earlier stage, you're building a very risky asset, right? Like my company in day one is worth nothing. So anyone who's giving me money is believing in me, and they deserve a bigger percentage of the company for that. And I'm clueless, so I need a lot of help. So I'm happy to give away more percentage to an accelerator. And so that's kind of the risk calculation that I go through. And if all this works out, we'll all be rich and happy, right? And we'll make a huge impact, and it'll be awesome. If it doesn't work out, we'll deal with it when we get there, right? But I think as an entrepreneur, you have to be an optimist and have to just care about the potential that this does become incredibly successful, and you do your risk calculations in that way.
Yeah, I think I can't agree more with Arman. I think there's a general stereotype that VCs are evil and that they want to take your money.
Does Richard seem evil to you?
I don't know. But yeah, so you gotta do your homework and the reference check the accelerators that you're entering into, and then terms that you have. And here's one statistic for you, that 250K for 6% ownership is competitive in the market. And by the way, we have a quick plug, we have a winter accelerator cohort. The application is open, and we're boosting the terms to 500K at 10 million cap. So that's 500K for 5% ownership. And so know the terms that you enter into before you sign up for the accelerator. The Secret of Sand Hill Road is a good one. Venture Deals is another very good book that references the term sheets and all that. So yeah, just do your checks. Keep an eye on your cap table. Know what you got yourself into, and seek advice. I think there are those evil VCs that exist out there still, but I think for VCs like us, we're pretty open, and if you have questions about term sheet, we're always happy to explain and do the calculation for you. Because at the end of the day, we want to make sure that you're happy, we want to make sure that the entrepreneurs are happy, so they feel incentivized about building the business that eventually I, as a VC, will also rip up the benefit as well.
We love the openness. Thank you, Richard. So to close out our panel, question to open up to kind of like the Slido. Again, what is one piece of advice you would give to our founders here today who are interested in joining an accelerator for both of you? I think, Arman, do you want to start first?
Yeah, so I think it's really like start from first principles of what is your company, who are you, and what is the best thing for you and your company. And I think a lot of people, like, the startup ecosystem is not immune to fads, and it's not immune to people thinking that something is cool and not cool, right? And I think that as a founder, you kind of need to get really good at just forgetting about all of those things. And maybe an accelerator is not good for you. Maybe building a company without any investors is the best thing for you. Maybe you should just start building your company while you're at your job, right? Like, and a lot of people that I speak to wish that they had done that, right? Like, so there's no one thing that's better than the other. And so I would just start there and think, like, you own the company, do what you think is best for the company, but also recognize that, like, at least for us, being in an accelerator has been great. And I think that's really awesome. And sorry, I'm kind of trying to lean into the point that Richard made, like just talk to people, just ask everyone for advice. I shamelessly ask people for advice. And all you're doing is just like gluing together things that you learn from people and somehow building a business out of that. So I think that I just want to double click into what Richard said.
Yeah, I think I would say number one, for advice to founders, number one, I think you should know why you're doing what you're doing, why you want to build a business. I think there are many folks who would want to build a business just because it's the cool thing to do. I came from the MIT community. I think within the greater Boston area, within the MIT community, there's an entrepreneurship bubble that every walking and living and breathing human being, that exists within the institute of MIT and Harvard, they want to build they want to start a company, right? And actually, someone coins the term, entrepreneurship tourists, right? They come into this bubble and they want to, and this bubble exists at many other great institutes as well across the nation. And they come into this bubble, they feel like this is that they want to do it because everyone else is doing it, and so that's how they enter. But once you leave the bubble, you start regretting that you should have just taken that job from Facebook instead of building, being stuck here and building this company, because let's face it, entrepreneurship and company building is hard, right? And you got to know why you're doing what you're doing. That's number one. And number two is again, just can't agree with Arman more that not every company needs to go through an accelerator. Not every company needs to raise venture money. One of our partners here at Pair built a company and sold it to Cisco for over $1 billion, and he's never raised a single dime from VC. He's just been bootstrapping all the way through, right? It's, of course, that's a lot slower, but you also don't ever get diluted, and there are great businesses that get built that do not raise VC money. There are great businesses that are so-called not VC backable. And we can talk a lot offline about what that means. What kind of businesses are venture backable and what kind of businesses are not. But regardless, that's not a criterion for judging the quality of your business. So yeah, make sure the working relation that you're entering into with VC before you sign on to any deals.
Great advice from the both of you. Thank you so much for sharing your insights. So let's move on to our audience question, and please continue to upvote and send in questions, and I will go through, try to go through everything for the remaining time that we have. So first audience question, at what point in the process of building our own company would you suggest approaching accelerators? So I guess this could be for both, or if either one of you prefer to answer this.
Yeah, I can take the first shot here. I think you want to see, okay. So again, every accelerator is different. Some wants to see some tractions, and other are okay if you just come in with an idea. At Pair, we are okay if you just have an idea on a piece of napkin. So that's fine, and I think other accelerators may want you to have some customers or revenues, but I'll speak for us. No ideas is too early. If you have an idea and you have a great vision, and once you go through the accelerator application process, if things align, we'll take you in. So there's no such thing as too early. I think the question is more for you to answer for yourself on whether you're willing to, to be committed and to put in the work for the accelerator in the next 3 months or so, right? Because it's definitely, it's definitely accelerated. It's definitely very intense. You want to make sure that, again, that you're committed to it before you get into the program. But that's for us. That's for Pair.
Yeah, I think. For me, it same. I think it really just depends. Like, are you, personally, I wouldn't recommend anybody go in with just an idea. Like, I think that maybe you can, I don't know. I also wouldn't recommend, like, if you have a bunch of traction and revenue, that's fine too. Like, what I'm trying to say is it really depends on, do you think that these next 3 months will truly help you accelerate, right? That's when the right time for you is. And so I think to Richard's point, like, I haven't had a weekend this whole summer, and like, it really is a commitment. And are you ready for that commitment? Like, does your life allow you to make commitments like that to your work? And are you at the point where this will truly help you and your business get to that next level, whatever that next level is? If you are making revenue, but you want to find product market fit, great. If you are not making revenue and you want to make revenue, great. Like, whatever your next level is an accelerator going to help you do that? Then that's the right time for you.
Awesome. Question from Anurag Zanini. Does Pair usually look for post-revenue startups, or does it operate on a case-by-case basis? How does this differ for a hard tech startup, i.e. hardware?
Yeah, that's a great question. We have startups that come in that already generate revenues, right? I would just preface the answer by saying that not every revenue is good revenue, and we can talk more about what that means. But no, that's not a judging factor. And your second question about hard tech, right? Hard tech, as you know, hard tech is hard, right? It's one thing if if your line of code doesn't work, and you can spend a weekend debugging, or and then it doesn't cost you that much, versus if a certain prototype doesn't work and you have to ask investors for money. I think for hard tech, I want to I want to say that I think for at least for Pair, where we're looking for again, where we're looking for basically that founder market fit, and we're looking to see if the founders have the ability to execute this hard tech business, and whether you have a plan to, say, minimize the risks of things not working out, and how you can operate on a low burn, on a low budget every month. So I think it's very important to address the question of how you plan to de-risk this technology R&D, and what's your plan so that you burn as little cash as possible as you define the MVP of your product.
Awesome. So question, I think this is probably for Richard. Does Pair VC accept applications from immigrant founders?
Oh, absolutely. We encourage founders from all backgrounds, especially underrepresented minorities and immigrants as well. Both of our general partners are immigrants from Iran and Spain, respectively. I'm an immigrant myself, and I think Armand came from an immigrant family. So yeah.
Amazing. So another question from Abrurag: given the early stages of a startup are so fluid, do accelerators necessitate a concrete founding team, and are they open to it changing during the Excel?
Yeah, that's a great question. I haven't been in my job long enough to give you like the actual answer. I've only been here for a few months, but I think at the end of the day, we think everything boils down to the utmost interest of the company, right? And that whatever is done right in the interest of the company, will support. So if at the end of the day, if pushing the company through the finish line means that we have to change leadership, I'd say let's do it.
Yeah, I think that, so if I could just chime in here, I think that, so there are a couple of other companies in the cohort that are looking for co-founders, right? And I know that Pair is being very helpful to them in helping them create a funnel to get people in the door, and then also helping them select between co-founders. And so adding to the co-founding team, definitely, like, we're seeing that happen right now. And generally, I think I think that this point is really highlighting that early stage companies, there's a lot changing. And I think that as an early stage founder, I remember that I was pitching people, and even right now pitching people, and like, you have to paint this picture of like everything is perfect and we have a plan for the next 10 years. And I remember myself thinking like, everything is in flux. Like, everything I'm saying feels like bullshit because I'm just making up a plan that I know is going to change in a month. Like, why are these VCs expecting everything I'm saying to be like set in stone and perfect, including in this case, the founding team, right? For us, we had our founding team, but like, everything's in flux. So why is everything expected to be set? And I don't think anything is expected to be set in stone. And I think Richard's answer really leans into that as well. Like, anyone who's investing in early stage companies is very likely to understand that everything is changing all the time. They want a really solid answer about the team and about the product and about the market, just so that they can understand how you think, to, again, understand whether you're the right founder for this market, right? It's really just to get down to that founder market fit. So when you're anytime you're pitching a VC or an accelerator or an angel, like, have that whole plan, even though you know that it probably is not going to be exactly what happens, just so that people can understand how you think. So I just want to mention that as well.
Yeah, and just to follow up on that, I think at one point I connected with a friend of mine who works for a VC, and he was telling me about a startup whose technology, and I kid you not, whose technology violates the second law of thermodynamics. And when the deal came in, my friend asked the founding team, how did you got funding, right? And they said, yeah. And he said, how did you get funding? Did you trick the angels or something? And the founding team said, the angel was a long-term friend of ours. They trusted that we're smart enough to figure this out in 6 months, but he said that in 6 months I'm out. You have to figure this out, right? So on the surface, it sounds like dumb and eager VCs bet on the technology that violates the second law of thermodynamics, but really it's a bet on the team and the trust on the team's ability to to carry this out.
Richard, there's a question following up on your intro. So you said you like community organizing. Do you have advice for people in a new city who are trying to network in its entrepreneurial community?
Oh, excellent question. So I'm very new to the Bay Area. I moved from Boston just a couple of months ago after living there for 5 years. I think for one thing, I do a lot of random messages on LinkedIn, and I say, hey, I think your background is very interesting. I'd love to connect with you, and I've connected with some great people that way. It used to be weird, I think, but that it's now the social norm to just reach out to randos on LinkedIn. I think nowadays it's pretty acceptable, and you can put it in a very candid way, saying, "Hey, I looked through your LinkedIn background. I think you have a very impressive background. I'd love to get a coffee with you." Right. So that's one thing. The other thing is find the kind of communities that you would like to be involved with. So there's a lot of meetup groups. I connect with the local alumni club of MIT, the MIT Alumni Club of Northern California, and organize events through them. So that's or participate in their events. So that's another venue. And the third one is you can organize events yourself. Actually that's how I sort of started on exploring entrepreneurship. That's how one of our general partner Pageman started his career. He was selling carpets, Persian rugs in a rug store in Palo Alto before he invested in Dropbox. And the way that he got to know about the entrepreneurs and the VCs is he started organizing these networking events at the rug store in Palo Alto, right? So I think that organizing events, bringing entrepreneurs together, that's definitely a solid way to go. It's been tested and it continues to work.
I also think that I think that there's this among CMU founders. I think that we're taught while we're at CMU that there's no CMU founders, whatever. Like I remember when I was at CMU 2 years ago, like everyone was saying, oh, like there's never been a big exit from a CMU company. Like we're not like MIT or Stanford or whatever. And then when you start a company, you realize that that's just absolutely not true. Like most companies are started by CMU people. It feels like every big company has a CMU name on it, right? It's actually nuts. So just get connected with the CMU network, even in New York where I'm at. If you're in New York, be my friend. And in every city around this country and honestly around the world, there's a really tight CMU network, and a lot of those people are very entrepreneurial. And CMU has an incredible reputation as well among investors and everything. So I'd recommend very deeply integrate yourself in that Tartan network, because it's been very helpful for me. My first 2 investors were directly through relationships that I had at Carnegie Mellon. And then actually, so we got into Pair because we were mentioned in the Schwartz Center mailing list. And then one of the partners reached out because they saw us there because Pair loves Carnegie Mellon as well. So CMU has been great. They're like the reason why I am where I am. So just lean into that.
Amazing. Thank you to everyone in the audience. Those are all great questions, but we are on time. Thank you again, Armin and Richard. You're both incredible trailblazers, and I really enjoyed today's session. Thank you so much again for sharing your journey and insights with us.
Thank you, Iris, for moderating.
Thank you.
And special shout out to the CMU T&E team. Thank you, KP, for organizing. Yeah, and thank you for having me to be part of this event.
Thanks, Iris. Thanks to Arman and Richard for being part of this event. We really appreciate the insights that you shared, and also to Iris for moderating this. It was really a pleasure. Thank you, and see you in our next event.
Oh, and KP, and if any of the audience would like to reach out to Arman or Richard for any further questions, is there a way for them to reach out?
Yeah, they could reach out via LinkedIn. I think we have shared that on the event page. So if you would like, you can definitely go and check back the event page again.
Yeah, I'm a LinkedIn person. I'm not a Twitter person. So reach out to me.
I was just going to say, I'm a Twitter person. You can hit me up on LinkedIn too, but I actually have on my LinkedIn, like, don't hit me up here, hit me up on Twitter. So, yeah, but either works. Cool.
So, and that's it for this Startup School event. We'll have another one happening next month. So stay tuned for that. Take care, everyone.
Thanks.
Bye-bye.
Bye.
Thank you.
Thank
Bye-bye.
you.
Thank you.